Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. For this week's episode, I'll be sharing the talk I gave at the Your Life, Your Terms conference in April. It was an honor and a privilege to speak at this incredible event organized by the great people at Rockstar Mortgages. In it, I share the IceCap approach, our views on a changing world, and of course, Canada's place in it. I hope you enjoy.
We got someone special for you here today. Richard Diaz, does anyone know Richard Diaz from the Loonie Hour? Yeah, okay. There you go, Richard.
He's gonna tell you got to listen to the Loonie Hour about 15 times during the presentation, so you'll know all about it.
So, Richard, I got to read your official bio here. I didn't know there'd be no light here. Richard is a macroeconomic strategist with over 15 years of experience, has worked with leading global institutions, passionate about making economics engaging, which he does. Data-driven approach and breadth of knowledge provide valuable insights and context into economic issues. Richard is an analyst with IceCap Asset Management. It's rare that we have somebody like Richard come in here. He is the very best we've seen in the country of Canada, putting economic data together for this country. So we're thrilled to have him here talk to you today. You're going to really enjoy him. There's only one problem with Richard, and he knows it. He's a Habs fan. So, if you feel like you want to start booing him right when you see him, that's fine. I get it. I would do the same thing. So let's give Richard a big, warm welcome.
My mic working? All right, thank you very much. Before I get started, let's give Tom, Nick, and the team a round of applause. This is just an amazingly well-organized event. Thank you. Let's see. Yeah, so hi, my name's Richard Diaz, and I work for IceCap Asset Management. I'm also a co-host of the Loonie Hour podcast, Canada's best and most important macroeconomic podcast in Canada. I understand that there's lots of fear and anxiety out there today with markets, the economy, what's going on. But before we tell you what we think and why we think it, I'm going to explain why we think this is an amazing, despite all of the volatility and the fear and anxiety, why we think there's actually an incredible amount of visibility. And that visibility to us means opportunity. But before we get into the big macro themes, what's going on with the tariff war, we're going to touch on the Canadian economics picture. Of course, we're going to touch on financial markets. And most importantly, for all of you, where mortgage rates are going. We're going to tell you a little bit about why IceCap Asset Management is different from the industry at large. And whenever we tell that story, we always talk about returns. Now, the industry is focused on returns, but all of you know that if you lose 50% of your money, you need 100% return to get back to where you started. A lot of the asset management industry is focused on just taking your cash, doing some kind of bogus risk assessment, and plugging it into some kind of product. Bonds that may or may not be risky, we'll talk about that in a second. And they set it and forget it. And I always think about that infomercial when I was a kid. I used to watch Saturday morning cartoons, and there was, this chicken, set it and forget it. And that's often what they do. But the problem with that perspective is what that means implicitly is that these asset managers, they treat you like a pension fund. And pension funds live forever, and we all know life is far too short. And people are insensitive to returns. And we also know that that's not true. You lose money, it can affect your health, your relationships. If you have a drawdown, which is a fancy way to say if you've lost a lot of money right before you've retired, well, that can affect your life choices, your retirement choices, if you can even retire. The other thing that a lot of these pension funds do, or not pension funds, but asset managers do, when they treat you like a pension fund, and I worked in London for 15 years, I worked for a hedge fund, I worked for a big asset manager based out of Switzerland, and it's this idea of outperformance. So it's an interesting concept. You have to be a finance bro to really wrap your head around it. And it's the idea that if the market's down 30% and your portfolio's down 25%, then you've added 5% value. And that you're definitely getting a bonus that year, which of course sounds crazy to a lot of people. What they care about is returns. They want to know what's going on. So at IceCap, we think about markets a little bit differently. Our view really is to protect your capital. We manage money for families all over Canada and the world. And our view really is if you manage those drawdowns, we focus on risk, that eventually those returns, they take care of themselves. And that's really a fundamental difference in how we look at the market and how a lot of the industry looks at the market. In order to, So when we think about risk and we think about change and volatility, and many of the key, and so so we're going to get to these key themes, but so when we're thinking about risk, volatility, change, the themes that these are the two themes that are driving our view of the world, what's going on, and of course this idea that we are entering a new world order. Tom, I think mentioned a little bit of that, and we share that view even though we come at it from a different perspective. And the first thing on this list is the end of the Keynesian supercycle. Now, some of you may be familiar. Does anybody actually know who John Maynard Keynes is? No? Yeah, okay, a couple hands here and there. Or Bretton Woods, how about that? All right, better. We're going to talk about Bretton Woods in a second, but ultimately it's the view that the old world of fiscal, which is government intervention, and monetary policy, which is basically changing interest rates, can affect business cycles and smooth out what's going on in the economy. We think that world is over. The second thing is global risk is synchronized. And what that means is because of economic integration, debt levels, interest rates, and a whole host of other things, we think that what might happen or what can happen in one country can have a material impact on the financial assets and the volatility of another country. And that the old rules of, let's say, correlation, or let's say diversification, where you can hide in one economy or sector, they don't apply. And we've actually seen that the last couple of weeks, where all the stock markets sort of fell in tandem, all the currencies fell in tandem, bonds, etc. All right? So we're going to talk, so first thing we're going to get into is end of Bretton Woods. And this is really important, just keep an eye on the time. Sometimes I go over. I like to talk. So the end of Bretton Woods. So some of you guys mentioned Bretton Woods. Well, Bretton Woods is a sleepy little town in New Hampshire. But at the end of World War II, it was the center of the universe. And it was the center of the universe because 44 allied nations got together to basically rebuild the world. Now, instead of bricks and mortar, they were focused on the global financial system in an effort to avoid the mistakes of World War I and the Treaty of Versailles. Why I'm giving you this lengthy history lesson is because this no longer works, and we think it no longer applies. So what's the Bretton Woods system? Well, it was in an effort to foster economic trade, cooperation, avoid the pitfalls, like I said, of the Treaty of Versailles, if you know your history, and basically build international trade, etc. They needed a set of rules and a set of principles. And a couple of those rules were as follows, and sort of pillars to reconstruct the world after, obviously, Europe and much of the world was in tatters. And those three pillars and an underlying philosophy were as follows. One was currency peg. Two was the US dollar pegged to gold. Three was the creation of lots of sort of international organizations like the IMF, the World Bank, etc. And the underlying philosophy of all that was the idea that fiscal, government, and monetary, interest rate, policy could smooth out the business cycle. The problem is we've reached the end of that sort of path. That part is over. And it actually started to fall away and fall apart long ago. So 20 years after Bretton Woods, countries started to ditch the currency peg. 1971, Richard Nixon left the gold standard, and that left the IMF and World Bank. Unfortunately, the amount of debt that's been accumulated, there's a chart on that later, and you'll see that the effectiveness, both because of debt and the just sheer size of the global economy, has rendered a lot of those organizations ineffectual. They're no longer as effective as they used to be. The final pillar or philosophy that still exists is what we think is now coming to a close. And that's the idea that governments and central banks can control the business cycle. And the reason why we think that that's coming to a close is, again, the idea of a massive amount of accumulation of debt. We talked about productivity a second ago, how that's falling, and obviously then we're going to talk about the disintegration sort of this old world. One of the key views that we have is, and again, this idea of new versus old, this old world of Bretton Woods, new world of falling interest rates. So when interest rates go up, that's bad. Forgive the simplicity there, but that's an important sort of idea. It means that you have tighter financial conditions. It's difficult for bondholders. Obviously, the equity market doesn't do as well. You guys are obviously familiar. If rising interest rates rise really rapidly, those real estate doesn't do as well, etc. Well, in 1982, it became the opposite was true. And so we had in 1982, you saw the decline of interest rates. That's good. And what I mean by that good, obviously simplistically, means it's easier financial conditions. It's obviously better from financial leverage. Companies can take on an incredible amount of debt. And importantly for governments, they can take on more debt and refinance, just like many real estate people do. They can refinance that debt at lower and lower levels and pay lower and lower interest rates. And that worked fantastically well. We know that many people in this room probably rode this interest rate decline to incredible riches. And there was other things going on too. You had globalization, you had productivity growth, you had the internet, computers. I don't remember a world without internet, but Keith tells me it's amazing. Keith's my boss. And but that was the reality for as long and that was the reality for most of the people in this room. They never knew a world. Well, actually, that's not true. There are some people in this room who probably borrowed at 20%. Raise your hand if you've ever borrowed money at 20%. My point exactly. And so, or 16.4%, let's say. But anyway, my point exactly. And so that world. So many people in this world have never lived in a world where you have interest rates rising. So fast forward to 2008, 9, 10, and we had a situation where there was a global financial crisis. Governments needed to borrow and spend to support domestic demand. Let's not litigate whether or not that was a good idea. The reality is it's what happened. And normally you'd have a situation where you borrow that kind of money and interest rates would typically shoot up. But enter in the alphabet soup and what's called non-conventional or unconventional monetary policy. You can see all these ZERPs and NERPs and QEs and whatever. And what that effectively did is what we call is suppress the yield curve. Now that's fancy talk for basically they just kept interest rates pinned to the floor. And there was intended consequences of that and unintended consequences of that. You can see on the chart, interest rates started to rise. We'll get to that in a second. But the intended consequences of that was to protect the banking system. On all banks and all major financial institutions, they hold bonds as regulatory capital. And that regulatory capital is really important because if you have a situation where everybody knows that, well, not everybody knows, you guys may or may not know, when interest rates go up, bond prices go down, right? And the opposite's true. When bond prices go up, interest rates go down. So if you have a financial system chock full of this regulatory capital in the form of bonds, you can't let those bond yields soar, right? Those prices will go down, and it'll put an incredible amount of pressure on those financial institutions. Well, that's why they kept the yield curve low. And like I said, there was intended and unintended consequences. We discussed the intended consequences. The unintended consequences was, of course, the speculative fervor in Canada. You guys are familiar with Mark Carney. One of my views is that in Canada, for example, we kept interest rates far too low for far too long, and that helped create asset bubbles in the real estate space. Sorry, Tom, it's true. But it happened all over the world. You could argue that that's the reason we had a speculative bubble in places like Ireland and Spain, et cetera, et cetera. Anyways, fast forward to, and so that situation, that 10-year period, what we call the lost decade, you'll see lost decade is a theme I carry through this presentation. And the unintended consequences of that was something what we called the scramble for yield, or the search for yield. And so because I mentioned to you like sort of balanced portfolios, where lots of asset managers will take an equity portion, which is the rock and roll, and they'll stick it with a bond portion, which is the steady eddy. And you're supposed to create a balanced portfolio that people talk around. So when markets crash, they say, "Who knew? We could never have predicted it." And when markets go, and when your stock portfolio goes up, everybody said, "Oh yeah, that's because we're really great stock pickers and we're really good." And in a world where you have the steady bond return, which we're going to get to, and those equity markets, it's fine. Well, when you suppress the yield curve and yields are too low, those investors search for income. And that's one of the major unintended consequences of that space. Now, I talk all about this is because we're in this new world. But before we get to that, I'm going to talk about, so what does this mean? So in order to search out for yield, they went up what we call the risk curve, all right? So they went from riskier stuff to corporate bonds, and then to junk bonds, but no one wants junk, so they literally just changed the name to stuff it into these portfolios that they sell you guys every day. Then they went to the alphabet soup. You guys are familiar with some of this alphabet soup, mortgage-backed securities, CMOs, all this shenanigans. And then finally, they went to emerging markets because nothing is better than lending a despot money. and then finally, private credit. The problem with that is that, that worked. Like I said, it worked for a long time. And what this chart is here is interest rate returns. Now, this is maybe a bit boring chart, but it proves a really, really important point, which is from in the 80s to basically 2010 to now, you had a situation where every year, if you owned a bond, you basically made lots of money and you didn't have to worry about it. So very little volatility, lots of money. You got money on the yield, and you got money because the bond price kept going up. But enter COVID, inflation that no one predicted, except for us, and you have a situation where the yield just simply rose from 1% to 4%, and you had one of the biggest bond drawdowns basically in a generation, or maybe even two. And so, and to the point where I ditched the chart, but it has yet to recover. So even if you include the returns you get from your coupon, that's the part of your yield, you still haven't recovered. And that's only one part of the equation. The scramble for yield also includes something called a spread. So what is a credit spread? This is a really important point. A spread is what includes all kinds of shenanigans, counterparty risk, currency, default risk, all kinds of stuff. And that's fundamental to the way bonds are thought of, perceived, and included in people's portfolios. People who never, ever signed up for that kind of risk. And the problem here is that as people scrambled for yield to increase the returns on these balanced portfolios, they went up the risk curve in a world where up until 2 weeks ago, I would say that we were at an all-time low in credit spreads. So there's two parts of the bond, which is, again, back to this idea that we're in a new world versus an old world. In an old world, interest rates were falling, everything was great and easy, and people didn't have to think about your portfolios, certainly the bond portion of your portfolio, and they would just talk around the returns or what have you. In this new world, where credit spreads are tight, people have gone up the risk curve, largely without the acknowledgement of their clients, and when we think that is a portion of the market that is a huge risk that is not acknowledged in the market. In fact, the point is, even after all the volatility of the last couple of weeks, bond spreads are still well within sort of a normal range. In a world where there's, let's say, as we discussed, bad GDP growth, higher inflation because of weak productivity, this is a major, major problem. And a lot of people who, like I said, signed up for non-risky asset portfolios, have no clue that they're their portfolios are chock full of private credit, emerging market debt, all kinds of stuff. And so this to us is like a major, major risk. The other major risk that people have is the equity portion of your portfolio. And so, you know, we're going to talk about Donald Trump, unfortunately, later, but the point, what I want people to understand is that, yes, the equity market has exhibited a lot of volatility over the last couple of weeks. But in January, you know, not to say I told you so, but in January we had a webinar, and we were worried about how vulnerable equity markets are. And this, to me, is one of the more interesting charts, which is the Case-Shiller P ratio. Now, you guys are familiar with valuations. You guys value real estate all the time. You have some kind of revenue number, some top line number, and a bottom line number. And this is about calculating that top line, and you basically have that valuation number is based on book value, net operating income. You guys are obviously familiar with that. How much are you willing to pay for a turn of that business or asset or whatever? And so this Case-Shiller P ratio to me is Case-Shiller PE ratio, Shiller PE ratio is really important because it's basically been at almost an all-time high. And in fact, even now, after the volatility or the drawdown, the decline we've seen of the last 2 weeks, you can see that it's still 2 standard deviations away, which means that it's extremely, extremely expensive. The other thing that's really important to note on this chart is you can see when interest rates are rising, that financial leverage starts to fall. People aren't willing to pay as many turns on that investment because they simply can't afford it. And the opposite's true. When interest rates, that red line is falling, people are willing to lever up like crazy. You guys have all experienced it over the last, let's say, 15 years. And again, this new world, we think interest rates are going up. Now, we're going to talk about this that's the old world, interest rates falling. The new world is interest rates rising. Why are interest rates rising? There's too much debt. We talked about productivity, and then we're going to talk about some political issues that affect that. So the old world is this Bretton Woods system. It's no longer effective. Interest rate inflection point, gone down, now we're going up. Too much debt, not enough productivity. And the other thing, there's a couple of political things that are really important. One is that we think that global cooperation is obviously changing. You know, Donald Trump, I'm sure, would like to take credit for all that, but we think that if he were to disappear tomorrow, none of this would change. And that's a theme we're going to carry on into the Canadian part of this presentation. The new world is upon us. So end of globalization, that's maybe a bit strong, but at the margin is what counts. We're still going to be buying stuff from all over the world, but the growth is really what matters. There's tariffs and protections. We're going to talk about that. And then obviously the political swing from left to right. And at the bottom, you see emphasis on global cooperation. So the shift from basically everyone worrying about global issues to people worried about domestic issues. All right, oops, sorry, go back. All right, so how does this basically manifest? So we think one of the most important things is the fact that, how does this change new world versus old world? The old world, global cooperation, new world, much less cooperation. And how does this manifest? To us, it's the bifurcation between the US and China. I think fundamentally everyone is distracted by lots of different issues, climate change, Russia, all this other stuff. The rest of our century, our lives will be dependent on the interaction between the two world superpowers. We might not like it, you might hate it, who knows? It's happening. And the faster you get your head wrapped around that and lean into that, the happier, well, not know happy, but certainly the more comfortable you'll be with the volatility and what's going on in the world. And I don't take my word for it, take the word of Marco Rubio. So Marco Rubio is he's the Secretary of State for the United States, and in his Senate confirmation hearing in the US, his 10-minute speech, so Secretary of State, for people who don't know, is the foreign minister of the US, and in his 10 minutes confirmation hearing, that's all he talked about was China, China, China. And this, by the way, was true 15 years ago. It started under Barack Obama, was carried through Trump 1, Joe Biden carried the football, and now we're just seeing an extension of that. And how does that manifest? It manifests from the pivoting of the United States from Europe to Asia. And again, that started with Barack Obama. Remember, he used to say, pivot away from Asia. And you can see this is putting pressure on Europe. And why this is important is for the next slide. But this is something that Canadians need to sort of reconcile, is that we haven't been doing our part, and the onus will be on us to lift our defense spending in accordance with this new world. Again, it's happening whether sort of we like it or not. So what about tariffs? So I think one of the more interesting things that we've seen over the last few years is that everybody hates tariffs except when they put them on themselves. And I think this is one of the more interesting charts. And so yeah, do I believe the rollout was particularly useful or conducive to global cooperation? Absolutely not. But look at the names on the bottom of this chart. All the and the following one, which is this one here. So you can see, this is something that a person last night asked me about, which is the non-tariff trade barriers. And this is fundamental to this view, that the world is changing. There's going to be more protectionism, less globalization. And it's one of the ways we know that is because the person or the country at the bottom of this list, the US, with the lowest trade barriers, non-tariff trade barriers and lowest tariffs, is now saying, we want to play this game too. And the irony, of course, is all the hand-wringing and all the complaining about tariffs comes from the people at the top of this list. And most people don't know this. We're certainly not told in the media that everybody loves tariffs. Now, whether are tariffs good or bad, I'm not here to describe this, but the point is that this is changing. And how Canada responds to this is fundamental. On the bottom right is one of the more interesting charts that I think Canadians don't know. And that's the incredible amount of non-tariff trade barriers within Canada. This chart is from a paper from the IMF from 2019, and you can see if we need to deal with this. So all this BS about Team Canada elbows up, we're not even trading within our own economy. How can we expect to live in a world where there's more competition, not more competition, but less trade, less cooperation, if we can't even cooperate within our own economy? And fundamentally, that red line means the non-tariff trade barriers, and the blue line is how much we charge the US. And so in a world, and to quote Keir Starmer, who is the PM of the UK, Prime Minister of the UK, the end of globalization is nigh. It's over. We're in a new world. And this new world, and in order to live in this new world, we need to start spending more money on defense, but more importantly, we need to start trading with our own borders and treating provinces in Canada a lot better, or at least as good as we treat the US. This is really fundamentally an incredible chart and explains a lot of the problems that we're having, and we're going to get to that now. Oh, Canada, a lost decade. So what does that mean? So we heard a little bit about GDP earlier, and this is where my presentation switched gears. So you've heard a little bit about our views on the rest of the world, why we think it's a new world, we think interest rate regimes are different, globalization, etc. So what is Canada's place in this new world, and how do we fit in? Well, in order to know where we're going, we need to figure out or understand where we've come from. And where we've come from is, frankly, a disaster. And I think it starts out with GDP per capita. Now, what is GDP? As Tom eloquently said, it's basically the productive capacity of a given economy. Now, I'm an economist, so I have to defend the turf. I think it's actually not a bad indicator of how things are going, so forgive me for being a homer. But one way to think about it is it is basically the kind of the most obvious and easiest way to figure out the standard of living of an economy. And you can see why I wrote perception versus reality here is because what we're told is that GDP growth is rising. And yes, technically that's true, but that's fundamentally an issue of population growth, and we'll get to that in a second. What we feel, and our reality, is the red line. And you can see that it's basically been flat for a long time. It has not gone up. And I think many people in this room would share that sentiment. You're feeling something. I'm telling you the data is confirming what your instincts. The other thing that's important to know is Stephen Paulus also mentioned that we're in a recession, even though not technically. But that's not good enough. How do we compare against other countries? It's an absolute disaster, okay? That is the only way to explain it. So what is this chart? This is GDP per capita. So your standard of living, your GDP per capita, so with all the technical necessities, purchasing power, dollar considered, everything, and you compare this growth from 2015 to 2024, which is where the data ends, and you compare this to 38 OECD countries. And the only country that we beat has 12 people and a bunch of German castles that live in it. And that's Luxembourg. Are there any people from Luxembourg here? Good, because it's not a real country, which means that Canada is abysmal. I mean, this, in my view, should speak for itself. This is an incredible indictment on how our economy has been managed. Now, let's be clear. Every other country suffered COVID, okay? Some countries, Sweden didn't lock down. Other countries locked down like crazy. This is what we've dealt with. This is what you're feeling. This is what your kids are feeling, okay? And there's no other way to describe it than a lost decade. From an economist perspective, this is incredible. It's fascinating. I'm marveled that a country with the largest oil reserves in the world, with obviously extremely well-educated and very good-looking people, could ever suffer this kind of economic malaise, is what we would say. So how do we? And they say, well, isn't this always the case? Hasn't Canada always sucked? That's what I was told the other day. Oh, it was always this bad. People have always been bitching about economic growth. And that's true. People always bitch about economic growth. I get it. Everybody wants to be rich. No one wants to work. Fine. But what's fascinating about this, again, from an economics perspective, is that that's not true at all. From 1994 to 2015, we actually rose lockstep, almost to the penny, with the United States. Not that the United States is the be-all, end-all, but it's pretty good, and we should at least try to keep up. And you can see that's what this chart is. So the red line, Keith, is Canada, and the blue line is the United States. And you can see this is just all this data is publicly available data. It's just GDP divided by the number of people who live here. And for a long, long time, it rose lockstep. And then in 2015, something happened. Anyway, I'll let you guys decide what happened. But the point is, really, listen, the numbers are the numbers. And that's the situation we're in. So why, right? We're going to get to where we've come from to hopefully where we're going. And so this chart explains part of the story. And what that chart, the other chart shows you versus the U.S. is basically Canada is facing a productivity emergency. Those are not my words. Those are the words of the Deputy Governor of the Bank of Canada. And when any banker or auditor, they never use any extreme language, partly because it's a legal thing and partly because they're boring people who work for central banks. But the key thing is that when they use words like emergency, you have to pay attention. And she said this in March of 2024. And I bring Carolyn Rogers up, number one, because I have a crush on her, but number two, because it's fundamental to all Canadians that we understand what's going on here. This is a productivity emergency, and this emergency is serious. So what that means is that red line at the bottom is the productivity growth. So, we heard an explanation of GDP. Here's another one. You have number of people, how productive are they? And you can see, I know there's lots going on here, but that red line is now negative. I've used a 5-year compound annual growth rate to smooth out all the wiggly bits, but the point is we are no longer, that doesn't mean you're not working hard, it means that there's something wrong with our economy. And one of the things that's wrong with our economy is that we just simply invited too many people to live here. Now, I shouldn't have to qualify this, but I'm going to. My parents are immigrants. I'm very, very proud of them. They love this country. They came here in the 70s. They worked very hard and paid a shitload of taxes. And it's not about immigration. The dose makes the poison. And something's gone wrong. And you can see from 1980 to 2015, the average population growth was 319,000. That number was tripled, okay? No economy anywhere, under any circumstance, at any point in history, can absorb that many people without having a significant impact on society, culture, hospitals, schools. Come on. This chart is an incredible indictment on what has gone on. Now, I'm not saying doubling, I'm not saying by increasing 50%, tripling, okay? And what that means is that it affects people's decisions on capital. So why invest in new business processes or in your business when you can hire cheap labor? As an economist, this is well understood. People have known this for very many, many years. If you have cheap labor, you don't invest in capital. And that's the next piece. The next piece is something, this is sort of fancy economics parlance, but it's called capital shallowing. It's bullshit. Basically, we're not investing enough in our society. Companies are not spending enough money investing in intellectual property, businesses, non-residential, fixed capital, whatever. And you can see, again, it wasn't always this way. Now, not always to compare ourselves to America, but you can see, even after the great financial crisis, our capital, we invested capital, CAPEX, sufficiently in line with the number of people who lived in Canada. And you can, and that's fundamental, right? In order to improve productivity, you have people, sure, but you need to give them tools in order to be effective and contribute to your society. So as we move in, okay. So, and the other thing is that people, and obviously businesses understand this and they're running away. So this chart is investors going abroad. So you hear a lot about foreign direct investment. That's a red herring. It's Canadians that are looking around and they're leaving. And that's what that red chart, that red line at the top is bigger than the gray line. So we mentioned that Canada has too much debt. And again, this is also hurting us. Folks, we got to stop spending, or we got to get more productive. And how do we get more productive? So, and that's on the left, on this chart, you can see that Canada's debt to GDP is the highest. So listen, this is all a pretty bad story. I'm going to make it even worse. So what does all this debt mean? It means that in a world of rising interest rates, remember, we're in a new world now. Interest rates are no longer falling. That's done. Interest rates are, at best, going to rise. Maybe they'll rise a lot. And when you have a lot of debt, it means that you have to pay a lot of interest. The budget will not balance itself, which is asinine, by the way. And you know what? But that rhetoric has a real cost. And that real cost is that your federal tax dollars, and provinces too, are paying an increasing amount of interest payments. So this chart, there's lots of stuff going on in this chart, but you can see the red line is interest rates. They used to fall, everything's great, they're rising, and you can see the exponential rise in interest payments. And here's the saddest chart we're going to finish off with some optimism. What this chart is federal interest payments, that's on the left-hand side, is federal interest payments in billions of dollars, okay? So we pay, what is it now? I should probably just look here. I can't see, it's too small. 53.2, I think. And, yeah, 53.8. So $53.8 billion in annual interest payments. And guess what that beats? On the right-hand side is a table, and that table comes from the November budget announcement, which was late, by the way. And it comes from the November budget announcement. It's table A18 or 818, whatever it is. And that line item that I've highlighted is federal health transfers. So are you guys content with your healthcare system here? No, neither am I. Healthcare spending, interest payments are now bigger than healthcare spending in this country. So budgets do not balance themselves. There is a cost, and it's especially true in a world with rising interest rates. And that's the new world we're in. And it affects bonds, it affects everything. So, all right, that was kind of sad. Now let's talk about optimism. What's going on, and can we fix it? And I believe we are. I'm naturally, I'm the youngest of two siblings. Of course, I had it easy, and I'm an optimist. And so I'm going to end you on a positive note, because it's way too early in the morning to be sad. And I think that Canada has a bright future if we want it, but we have to acknowledge some realities. Canada is a petro-state. All this navel-gazing about it is completely useless and just wrong. The data is very clear. This chart is about net exports. What's net and what matters to the economy on a sort of technical level is net exports. Net exports are basically, so you can see energy products are our biggest contributor. So basically Canada sells natural resources to pay for imported goods. That's not to say we don't make imported goods, but what matters to our inflation, monetary policy, tax base, on and on and on and on, is the net number. And that's what this chart shows. So we need to own this if we're going to be serious about improving our productivity, our living standards, etc. Another way of proving that Canada is a petro-state is to show you how Canada has a petro-currency. And this chart, I know there's lots going on here, is basically the price of oil in blue with a basket of a basket of currencies. So Canada versus the yen, euro, and the pound. This used to be true versus America. America no longer imports oil, more or less. Let's just, for the sake of brevity, they no longer import oil in net terms, whatever. Canada is a major oil exporter, and our currency moves lockstep with oil. We are a petro-state, or we have a petro-currency. And so that, and even in the last couple weeks, you can see, lo and behold, this is still true. Why is that a good thing? Because fossil fuels are not going anywhere. And that's just a fact. Now, let's look at so the fossil fuels are basically three large categories. Coal, China is the largest consumer of coal. 60% of China's energy is coal. Yes, they are leading the charge for renewable energies. On a relative basis, they are improving but they consume the lion's share of the world's coal. Asia is building 974 new coal-fired power plants. Coal is not going anywhere. India's just doubled down, and Indonesia's doubled down. Crude oil. Human beings consume 104 million barrels of oil per day. Our energy minister just said that oil is peaking in 2024. He's an idiot. That is not true. No serious economic or financial market thinker thinks that oil is peaking any time in the next 50 years. That is not a real statement. And for the energy minister of the fourth largest producer of oil in the world to say that is a dereliction of his duty. And the third thing is natural gas. Natural gas, we are the fifth largest producer of natural gas. We have an incredible amount of reserves. Oh, sorry, we have the fifth largest reserves. We have lots of natural gas. And the second thing, so that's the fossil fuel stuff. It's not going away. As a share of global energy consumption, yes, fossil fuels will fall. This is an aggregate number from 1930. We need it. It's it. We live on a cold, dark, shitty blue planet in the middle of an infinite solar system and universe. We need fossil fuels to maintain, to fight entropy, to get philosophical. It's not going anywhere. The other thing is electric cars. And you can see electric cars, if we're into them, need an incredible amount of minerals. Guess who has, 6 times as many. Now, will this fall as we get better with batteries? Sure. Still need an incredible amount, and this is just electric cars, incredible amount of minerals. Who has, as we're running out of time, we're gonna skip this, but who has an incredible amount of minerals? We do. We're the second largest landmass in the world. We have literally every single mineral that you need. And so this is fundamental to Canadians. I think we need to stop apologizing for what we have and who we are and what we can offer the world. And remember, in this world of bifurcation, New World Order, Old World Order, New World Order, China, US, we're going to pick sides. Less globalization, more globalization. It's a reality. Interest rates. We have everything that we need to be successful in this new world. And we just need to sort of either start digging holes and stop apologizing for it. This, by the way, comes from the 2022 budget. The government fully understands this. It should not take 17 years or what have you to open up a new mine. And so for me, as an optimist, I see incredible opportunity. We just need to stop pretending we are something we're not. All right, so the most important thing, the reason I'm here is obviously mortgage rates. That's all you guys care about. And for that, I'll end quickly with, I know I'm going over time, but we're going to talk quickly about inflation. So part of so people talk a lot about tariffs and how that's inflationary. I'm not so sure. Inflation was happening beforehand, right? So we make the case on the Loonie Hour that Canada's been in a recession long before Donald Trump started saber rattling. We still think that's true. I've demonstrated that Canada's been in a recession. The same, I would argue, is true for inflation. Canada's been suffering. So this is the IceCap inflation model. Models, you never marry a model. But for now, it seems to be working. And we can see that inflation's coming on. It's coming on because the Canadian dollar's weak, and more importantly, raw materials, which drives inflation in Canada, is starting to rise. And that's why I said I was going to end on a positive note, but it's semi-positive. And that's why the Central Bank of Canada is in trouble in a sense, because they are in, I'm sure they would love to lower interest rates, but in a world of rising inflation, there is a floor under those, there's a floor under those interest rates. They can't just lower interest rates to fight Donald Trump because he's a bad guy and whatever. They're in a situation, their mandate is to fight inflation, or at least keep inflation within the target. And with that in mind, even if Donald Trump were to disappear tomorrow, mortgage rates would probably stay around where they are. And that's what this chart is. This chart is central bank target rate with the conventional mortgage rate. And those dots are the expectations. So that's to conclude, basically, we are in a new world order. We've demonstrated where we've come from, why it's different. We think that if investors embrace this new world order, as Tom eloquently said, there's actually an incredible amount of opportunity. We think that Canada is already in a recession. In fact, you could maybe even make the case we've been sort of in a depression, frankly. This is a function of productivity, obviously immigration growth, but most importantly capital, and how we basically scare as much capital away from Canada as possible. And the third thing is there really is opportunity, and we should embrace who we are, because it's the only way we're going to get out of this mess. So, thank you very much.
Yeah!
I hope that was okay.
Thanks, man. It's great. It's so hard to find Canadian data, guys. That's why we like it
Sorry, I went
when
over.
someone like, no, it's okay. We'll let you off this time.
Okay.
You know what? As punishment for going over,
No,
in tonight's game, you have to cheer for the Leafs.
No, I can't do that.
No, what do you mean? What do you mean?
I'd rather jump in front of a truck.
Really? Okay, get off the stage. No, I'm joking. No, thank you. But seriously, guys, it's hard to find the Canadian data. That's why it's so good. Genuinely appreciate it. It's no problem at all. Right?
All right, thank you very much.
Thank you very much.